It's a very good time to be in the marketplace. It actually has been a bit of a surprise. Hi, everyone. This is Christine Kopr from Sotheby's Realty reporting to you from Prague in the Czech Republic. This is your May 2024 market update. It's been a wonderful experience doing a little bit of travel in Europe to see how things are evolving in the real estate market here compared to the Vancouver real estate market. And while sometimes we feel like Vancouver is alone in its housing crisis, that may not be the case specific to Vancouver, and I'll be touching on that in future episodes. Let's take a look at how the month of April ended up for your May market update. And if you have any questions, please reach out to me. For those of you that follow me every month, we like to take a look at the numbers in this grid to give you a good perspective of what's happening in the real estate market. It actually has been a bit of a surprise, some of the changes and the evolving nature of our marketplace. The spring started off very busy. We were seeing multiple offers, a lot of activity, and we continue to have strong activity, although it is starting to soften a little bit and some of the numbers are changing. Let's take a look at the dynamics of today's marketplace. The end of April reported 2,831 sales. Month over month, that was a 17% increase and a 3% increase year over year. So if you recall, this time last year, we were going through a pretty active real estate market. Our sales are slightly stronger than that by 3%. However, we are 12% below the 10-year average. But when we take a comparison to last year's, we're 3% above the activity, which fueled some price appreciation, which in some cases have brought prices past their COVID peak. We had 7,092 homes come on the market, which is a 42% increase month over month. Definitely some big numbers here as the market dynamics are starting to shift. From a year over year perspective, that's a 65% increase in inventory for buyers to buy. It sounds like a very big number. However, in terms of overall marketplace, we have had a need for listings. If you don't have inventory for people to buy, you just don't get the sales. And one of the things that's showing up is good properties are selling. With respect to new listings, 7,092 new homes came onto the market. So it'll be interesting to see how this plays out over time. Total active listings, and it's a very interesting number. We hit 12,491 available homes in the marketplace. It's the first since COVID when we had a higher amount of inventory. Inventory has increased month over month and a 42% increase year over year. So again, substantial increases. It is 17% above the 10-year average. What's been very interesting is while the inventory has come on, market participants had thought that as interest rates were increasing, we would see a decrease in prices and we would also see a lot of inventory coming on. And so far, we're just starting to get into more healthy levels of inventory, because if you actually look back into the past, while this is 17% above the 10-year average, we've barely had any buyer's markets in our marketplace. Going back 10 years, we've basically dipped into a buyer's market only a couple of years at a time. So 12,000 or almost 13,000 homes on the market is not it's not a crazy amount of homes available to buyers, and it actually helps create a healthy marketplace, more potentially balanced market conditions, but we'll see how that's actually playing out in each market segment. As you know, for those of you that follow me, I focus on months of inventory. It's that quick glance to let you know, well, where is the market actually heading? And supply and demand are really the things that are going to tell you which way prices should go. And if we see a trend, something that happens month over month in a certain dynamic, it should give us an idea of where prices are going. And currently we're sitting at 4.4 months of inventory. For those of you that may not follow me all the time, 4 to 6 months of inventory is considered a balanced market. Over 6 months of inventory is considered a buyer's market. So 6 months and above is considered a buyer's market. There is more inventory than there is sales, and inventory starts to accumulate, putting downward pressure on prices, which in some ways we're starting to see a little bit, but it's really actually not happening on the street at this point in time. 4 months and below is a seller's market. We're just on this cusp. And in fact, since the end of last year, heading into the spring of 2024, we've actually been reducing our months of inventory. This month has been the month with a lot of inventory coming on, but let's also put into perspective that we are in our spring market. This is the most active time of the year. This is when most people list their homes, and the sales are there supporting this marketplace. It's a very good time to be in the marketplace, whether you're a buyer because you have more inventory. And as sellers, there's still some strong activity and there is strong demand. However, you do have to be pretty particular in how you prepare your home, how you list your home, and your marketing strategy. Every home is very unique and its situation, and that is going to impact how to navigate this market, especially if these trends continue in terms of our consistent sales activity, but perhaps elevated inventory coming on into the future here. The part that's a bit wild is that prices continue to appreciate. And while we've had this increase in inventory, we've actually had very strong price appreciation in terms of the benchmark price. At the end of April, your benchmark price for a home in the greater Vancouver region is sitting at $1.206 million. That's up 0.8% month over month and a 2.8% increase year over year. So you're seeing that appreciation. And as we head into the next slides, we're going to talk about breaking it down into each market segment. Metro Vancouver, detached homes sales were up 0.7% year over year. Your benchmark is sitting at $2,040,000. Benchmark price year over year is up 6.3%. Amazing on a $2 million purchase price or $2 million valuation. And your benchmark is up 1.6% month over month. These are strong gains in this current environment, and it's not what most people would have expected. Townhomes sales are up 16% year over year, with your benchmark price sitting at 1.127. Your benchmark price is up 4.3% year over year and up 1.3% month over month. Condos, this is the one market segment that is taking a little bit of a slowing pace. There's more inventory coming on, a little bit less demand, and probably attributed to some of the changes that are happening in the marketplace with regulations regarding Airbnb, investors with their mortgages, etc., and is probably an excellent opportunity for those of you that are looking at this segment. Sales are up 0.2% year over year, price sitting at $776. Benchmark price year over year is sitting at 3.2% with 0.1% decrease. So basically flat in that marketplace, but still holding. And let's take a look at how each of those market segments are looking with respect to the sales ratio and months of inventory. Inventory for detached homes is up 32%, definitely needed. We are sitting at 5.8 months of inventory, which is almost at a buyer's market, but still sitting in balanced market conditions. Months of inventory has crept up a little bit, 1.75% month over month, and we're sitting at an 18% sales ratio. So 21% down to about 12% is considered that balanced market. And we're putting in the sales to actives ratio in here because it gives us a little bit more of a fine tuning of where we're sitting at with respect to the demand. Months of inventory is a little bit more broad. The sales to active ratio is a little bit more specific. Townhomes inventory is up 41% year over year. There's only 3 months of inventory, so definitely in a seller's market. Months of inventory crept up 7% month over month and is sitting at a 31% sales to active ratio, very much in a seller's market territory. 22% and above is considered seller's market, and we're sitting at 31%. Even with a little bit of a decrease, we're still in a very strong seller's market. For condos, inventory is up 37%. Months of inventory is sitting at 3.7. Month over month inventory, though, has somewhat trickled down a little bit, 3.7%, so almost 4%, and your sales to active ratio is sitting at 26%. It's a little bit of an interesting market. There's more volume that's come on. Months of inventory has decreased because the sales are there. However, what we're starting to see, remember, we are looking back into time. There is a little bit more of a shift in that condo market, and there is going to be some more opportunity showing up specifically in those downtown condos where there's more of that kind of inventory coming on. Now, to put it all into perspective, while we look at these month over month changes, they don't make a market. The trend is your friend. Historically, you can see we hit the peak back here. We took a little bit of a dip coming back up, but we're still on trend. While we are seeing these changes, you can see where we are from where we've been, and it's pretty spectacular in terms of the average residential sales price for the greater Vancouver region. Now, we've had some regulation changes that came up. The capital gains taxes increase that's going to come into effect June 25th. For your personal capital gains over $250,000, you're going to now be taxed on 66% of the gain over $250,000 at your personal marginal tax rate. Corporations, all of your capital gains are going to be taxed. And while the government says that's not going to impact many people, it actually does impact pretty much every self-employed person that is incorporated as well as large corporations. So while there's a narrative that says it's only impacting those heartless corporations, it actually does impact individuals all around you, especially for those of you that are self-employed and or run small companies that are incorporated. Depreciation reports are going to now be required. Stratas are not going to be able to opt out of them. You're going to have to do one once every 5 years so that buyers can be educated about what's happening with the property. It's going to be required for all stratas with 5 units and above. There's no opting out. And for any strata that was created before January 1st of 2024, and you have reports older than December 31st, 2020, you are going to have to get an updated report done by July 2026. BC short-term regulations came into effect May 1st. Short-term rentals that are less than 90 days are limited to your principal residence and one additional suite on your primary principal residence if you're in a house, if you have a basement suite or a laneway house. It's applicable in municipalities with a population over 10,000 and any communities that chose to opt in that are smaller. Non-conforming use will no longer apply to short-term rentals. So in some municipalities, there were some old grandfather bylaws that allowed short-term rentals to exist, but the BC government is now abolishing that as well. So that's taken in effect. You need to check in on the municipality where you want to do short-term rentals or where you're conducting short-term rentals, because they can change. Some municipalities that have vacancy rates that are above a certain percentage for a couple of years have opted out, like Fort St. John and Dawson Creek. So you really do need to dig into your municipality if you're thinking about conducting short-term rentals. And of course, you also have to register with the BC government and let them know that you are going to be conducting short-term rentals, as well as pay your fee for that licensing, plus anything with respect to your municipality where the property is located. And then there was an announcement from the federal government that first-time home buyers are going to be able to withdraw up to $60,000 out of their RSPs for their down payments to help making home ownership more attainable. Mortgage rates, the Bank of Canada interest rate has not changed. It remains at 5%. And then, of course, the banks have their prime rates that are higher than that. Some banks are giving out some big discounts right now. I heard TD is giving out a whole 1% discount from the variable rate. So that's a big discount. The bond market has also calmed down. When we did this a couple days ago, we were sitting at 3.96%. The bond market is what controls the 5-year fixed interest rate. The banks will lend to you at a premium above this, but as you can see earlier this year, we were much higher, like closer to 4%, toned down there in January when we started to see really low fixed rates again, somewhere around that 5% interest rate for 3 years, even 4.8% or to 5.5% for 3 years in up to 5 years. So we're starting to see some movement in those interest rates, but they continue to remain elevated. And I think that while there's been a lot of discussion about the Bank of Canada reducing that short-term interest rate, which is your variable interest rate, which would impact all line of credit holders or anyone with a variable rate mortgage, that we could see some decreases to that interest rate in the near-term future around June or July. I'm not sure that that's going to happen because there's a lot of pressure on the Bank of Canada right now, and there continues to be inflation occurring in the marketplace. We just got the employment numbers, and for Canada, unemployment has stayed the same while we created 90,000 more new jobs. So that puts some pressure on the Bank of Canada. The economy doesn't seem to be in a negative, challenging place where reduced interest rates would benefit the economy. And even in BC, our unemployment rate has actually fell while across Canada it remains the same. I wouldn't be holding my breath for a rate change, especially since we have to be careful that we don't lower the rates for a Canadian dollar. Otherwise, we would experience inflation from buying all of our goods in US dollars. I think that if we see an increase in our short-term interest rates this year in terms of the variable rate, I think we'd be lucky to have that by the end of the year, or maybe early next year. But your fixed rate mortgages, I think, are a really excellent opportunity to secure, watch that bond rate to pick up a 3-year bond rate and then ride out this higher for longer inflationary period. Things are heading in the right direction, but I think it's just going to take a little bit more time for this to really work through the marketplace and encourage the Bank of Canada to make some changes. The other thing that's sitting out there is the amount of mortgages that are going to renew into this higher rate environment. And we've already gone through 2023. We're almost halfway through 2024 without any major changes in prices in terms of, having people needing to sell their homes because of the current interest rate. And we're also in a year that has more mortgages renewing. As you can see, this year we have 722,000 homes that are uninsured that are renewing versus last year. And next year we'll see even more. So there will be more renewals coming next year. And this is one of the things that the Bank of Canada is watching. However, it seems that it hasn't been impacting the market that much. Market drivers, consumer confidence remains strong. Inflation has been tamed. It's sitting under that 3%, which is the goal of the Bank of Canada. Wages are increasing, so the economy is strong there. And interest rates are kind of hovering in this ping ponging around the 5% to 6%, depending on your situation. And inventory is finally increasing. So there is an opportunity to find a better product. We know the market is hungry for selective product, but there, as a buyer, as someone who's into the entry level market, could probably take advantage of that opportunity. I'm Christine Kopr with Sotheby's Realty in Vancouver, BC, reporting from Prague in the Czech Republic. And that is your market update for May 2024. I look forward to any of your questions and look forward to seeing you next month. Take care.